The silver flash crash. What Wall Street doesn't want you to understand. February 5th, 2026. While you were sleeping, silver collapsed 16% in hours. No news, no warning, just wealth evaporating in the dark. But here's what nobody's telling you. This wasn't random. And understanding what actually happened reveals how modern markets are rigged against retail traders like you. I'm going to show you exactly what happened, why it happened, and most importantly, how to protect yourself when it happens again, because it will happen again. What actually happened? Let's start with the facts. On February 5th, silver was trading around $8,789 per ounce during normal hours. The market seemed stable, maybe a bit choppy, but nothing alarming. Then, at 10 p.m. Eastern, when most of America was in bed, the bottom fell out. Silver plummeted from $88 to $73 in just hours. That's a 16% crash with zero explanation. No Federal Reserve announcement, no geopolitical crisis, no industrial demand shock. Just a brutal, unexplained drop that wiped out billions in value while retail traders slept. By morning, silver had clawed back to around 81 ors. But the damage was done. Stop losses triggered. Margin calls executed. Retail positions liquidated at the worst possible prices. Gold down barely 2%. Stocks flat. Platinum a modest 5% dip. This was laser-focused on silver, and that's your first clue that something deeper was happening. The pattern. They do not want you to see here's what makes this truly fascinating. February 5th was not unique. It was the second act of a coordinated pattern. Silver hit $121 in late January, then it crashed 35% in days. Now, this after-hours massacre took another 16%. We're watching the same playbook run twice in 2 weeks. Why? Because silver wasn't behaving. It was rallying too hard, too fast. And when that happens in commodity markets, the big players have tools to bring it back under control. The technical setup was textbook silver, formed what traders call a rising wedge, a pattern that screams trap to anyone paying attention. Prices grinding higher but with weakening momentum, like a runner hitting the wall. When silver tested $90 and failed, that was the trigger. The wedge broke down. And that's when the machinery kicked in. The leverage trap. Here's how they got you. Futures contracts use leverage. You can control $100,000 of silver with just $15,000 down. Sounds great when you're winning, fatal when you're not. And right before this crash, the CME Group, the exchange that controls silver futures, raised margin requirements from 11% to 15%. Translation: they made it more expensive to hold silver positions right as the price was breaking down. Coincidence? Let's walk through what happened next. Step 1. Honst. Silver breaks below technical support around 85. Step 2. RAS. Stop-loss orders trigger automatically. Step 3. Those sales push price lower. Step 4. Lower prices trigger more stops. Step 5. More stops trigger margin calls. Step 6. Margin calls force liquidation. Step 7. Forced liquidation accelerates the crash. This is called a liquidation cascade. It's a self-feeding death spiral, and it was turbocharged by 3 factors. After-hours timing. Minimal liquidity means every sell order has maximum impact. In a liquid market, you might move price 1%. In thin after-hours trading, try 5 to 10%. Algorithmic trading. Computer programs watch for broken support levels and pile on automatically. No human judgment, no mercy, just ruthless execution. Margin pressure. Traders facing that new 15% requirement had a choice. Deposit more cash immediately or get liquidated. Guess what most chose at midnight? If you don't know Fibonacci levels, here's what matters. They're mathematical ratios that markets respect with eerie consistency. The 61.8% level, called the golden ratio, is where major corrections often stop, and silver bounced there, hard. Not once, but multiple times across the week. That tells us something crucial. There's real buying demand at those levels. The 2 silver markets. Most people do not understand this. There are actually 2 silver markets operating simultaneously. The paper market. Futures, ETFs, derivatives, where prices are discovered and leverage rules. This is where the volatility happens, where the games are played. The physical market. Actual bars, coins, industrial consumption, where real metal changes hands. This is where actual supply and demand live. On February 5th, while paper silver was crashing 16%, physical dealers reported something remarkable: aggressive buying. When silver hit the low 70s, people buying actual metal stepped in hard. Why? Because physical buyers aren't trading on margin. They're buying to hold. They have different incentives entirely. Industrial users securing supply for manufacturing, investors preserving wealth against inflation, collectors accumulating. These buyers saw a 16% discount and said, "Thank you." Shanghai premiums, the price difference between Chinese and Western markets, stayed elevated at 10,022 per ounce. That signals continued global demand outside the futures casino. Here's the lesson. The paper market creates volatility. The physical market creates support. Understanding this split explains everything about how precious metals actually work. What this reveals about modern markets, let me be direct. What happened February 5th wasn't manipulation in the conspiracy theory sense. It was something worse. It was the system working exactly as designed. Modern markets are built on leverage, algorithms, and structural advantages that favor institutional players over retail traders. The game isn't rigged by shadowy cabals. It's rigged by the rules everyone can see but most people don't understand. After-hours trading when retail is asleep, legal. Raising margins during volatility, standard practice. Algorithmic trading that accelerates crashes, perfectly allowed. Stop-loss hunting in thin liquidity, just good business. None of this is conspiracy. It's all disclosed. It's just that nobody reads the fine print until after they've been liquidated. The real lesson. Here's what February 5th actually teaches us. Volatility is information. That crash told us precisely where strong buying demand exists, 73.76, where sellers dominate, 87.90, and how leverage amplifies moves in both directions. Corrections aren't failures. They're how markets process new information and shake out weak hands. Precious metals have always done this, violent rallies interrupted by brutal corrections that terrify novices. Price isn't thesis. If you believe in silver because of monetary system stress, industrial demand, or portfolio diversification, did any of that change between 6 p.m. and midnight on February 5th? No. The debt didn't disappear. Solar panel demand didn't collapse. Only the price moved. If you can't tolerate 20–40% drawdowns, you shouldn't be in precious metals, period. The volatility isn't a bug, it's a feature. Weibers, how to actually navigate this: stop treating volatility as your enemy. Start treating it as a signal. When you see a massive move with no fundamental catalyst, don't ask, what are they hiding? Ask, what technical pattern just resolved and where's the next support? Know the difference between noise and signal. Noise. After-hours volatility, stop-loss cascades, margin-driven selling, short-term panic. Signal. Support holding at key levels. Physical demand staying strong, relative performance versus other metals. The February 5th crash was pure noise amplified by structural mechanics. The signals underneath? Support held. Physical buying accelerated. The market bounced quickly. That doesn't mean silver's going higher. It means the structure is intact despite the volatility. Final thoughts. Most people lost money on February 5th because they confused price movement with fundamental change. They had stop losses at obvious levels. They used leverage they couldn't afford. They traded in markets they didn't understand. The professionals who made money? They understood the mechanics. They knew leverage creates cascades. They recognized technical patterns. They bought physical metal when paper crashed. The difference between them isn't access to secret information. It's understanding how the machine actually works. Silver didn't crash because it's broken. It crashed because leveraged positions unwound during thin liquidity after a technical pattern completed. Every piece was visible. Every move was mechanical, and it will happen again, because this is how volatile markets behave when human emotion meets mathematical structure. Your job isn't to predict every move. It's to understand the patterns, recognize the incentives, and position yourself accordingly. That's not sexy, it's not guaranteed, but it's real. And in markets where most people lose money chasing headlines, understanding reality is your only edge.